This is a download from BFM 89.9, the business station.
Good morning, Dodge. So U.S. job numbers are finally showing what people are hoping, with strong growth numbers for May. Do you think this will sustain looking at the current situation, taking everything into account? And because of that, when do you think the next taper will be?
Good morning, Nadia. And yes, from a pure economic and employment perspective, I do believe our current improvement is sustainable. There are several clear indicators to watch for potential negatives. 4 straight months of over 200,000 job growth. We're really no longer subject to the previous propensity for unexpected slowdowns or actual slumps in our job growth. With the 3-month average now running at 233,000, there's a clear easing of former drags on an economy, the tight household income and the tight fiscal policy that were real concerns. Long-term unemployment is starting to reduce while short-term unemployed is increasing. While we ultimately need both to decrease and the quality of jobs to increase, the trend that we're having now is supportive of a truly improving economy and employment picture. Also, the current job growth is supportive of sustaining increasing consumption this year. We expect our overall economy to grow at close to 3% for the rest of this year, and year-to-year date growth in aggregate earnings has now accelerated to an annualized rate of 6%, which will support improving consumer spending. Now, we will be watching for 2 indicators for early warning signals to the contrary. First, we're watching for an increasing pace of wage growth. So far, there's been no acceleration from 0.2% from the previous month and 2.1% from a year ago. Employers will start paying employees more when they can no longer fill the jobs easily. And this will be the early indicator that the economy's spare capacity has been depleted. Our Federal Reserve will likely stay calm until we experience about a 3.5% increase in average hourly earnings. So that's one warning signal. Second, our unemployment rate is not behaving as expected. Fewer people are returning to the labor market despite our improvements. This may imply damage of a more permanent nature that may have resulted from our slow recovery. Workers may be losing skills needed to find employment. And if this is the case, then there may be less spare capacity that the Fed is assuming, and this may also speed up the actual interest rate rise earlier than the Fed has indicated. So with those 2 in mind, we do expect everything to continue positively, and we expect taper to continue with the asset purchases decreasing by another $10 billion to $35 million in 2 weeks when the announcement comes out. We expect interest rates to actually increase still in January at the earliest.
Heading to Europe, the ECB has finally headed into negative territory. It's been a few days since the announcement, though, so how has the market taken the news, you think?
Well, the euro shook off the weight, holding firm this week, even as the ECB cut that key interest rate you're talking about below 0, and that was in its bid to stimulate lending and economic growth. Versus the dollar, the euro is up 0.1% this week and up 0.4% since hitting a 3-month low last May 28th. Behind the euro's resiliency is a rush by yield-seeking investors into stocks, high-yield bonds, and the riskier corners of euro-related markets. In the futures market, bearish wagers have been outstripping bullish ones by the widest margin since last August 12th. Despite the wide focus on that below 0% move, the most significant move the ECB did was its launch of a 4-year targeted long-term refinancing operation under which banks will be able to borrow from the ECB at exceptionally low interest rates, provided, however, that the funds that are lent go to the private sector and not in mortgage lending or government bond buying. The Eurozone's economic health will remain precarious for probably another year. The recent moves likely will fall short of a solution, Nadia, to the stubbornly high unemployment and torpid growth rates they've been experiencing. Joblessness actually is currently running at near 12% across the 18 members and over 20% in Greece and Spain. And at the same time, inflation has fallen to a quarter of the target rate of 2%, and Greece, Portugal, Slovakia, and Cyprus are actually experiencing deflation. Right now, there is a sort of a mini QE going on as the ECB has decided to stop withdrawing its purchases of private and public debt by way of interest-bearing deposits. And clearly, some form of real quantitative easing is still in the wings. We believe it will be rolled out later this year or early in the first quarter of next year. Longer term, the other concern that we have is a divergence that's going to be occurring between the U.S. and the Euro's monetary policy. That will weigh on the Euro. So there is some real hope now that Draghi has been able to pull the market through to the other side of all this. It's possible it will happen, but now we're seeing some very specific areas that we'll be watching.
Speaking of that, bond rates have also reacted. So what's your take on it?
Bond rates will continue to have increasing importance. Right now, we're not watching the bond rates as much. They are reacting to the short-term effect of what's been announced. Longer term, we expect the importance of bond rates to increase probably in October of this year. And so until then, we're going to be more focused on what's happening in the stock and the other areas that are competing for short-term money.
What's your comment then on how the first half of 2014 has been?
Well, from a market valuation point of view, the economic and fundamental performance of business in general has been not too hot, not too cold, and has not really stopped the transition of valuations from the easy money rates that we've been experiencing to the longer term back to the way things should be, which is on economic and fundamental valuations. Also, the trend has been positive. Number one, it's been improving. That's good. But also, as I said before, there have been fewer bumps, and now we don't expect the bumps to occur, whereas in the beginning of the first half, they were occurring fairly regularly and were almost expected. So we see the trend as positive. We see the rate of the trend being slow but positive and not negative.
In addition, what sectors do you think did better than expected?
We have seen airlines perform better, chemicals, railroads, some high yield opportunities in the real estate investment trust area, and utilities have outperformed. Oh, and oil related. Oil related has really been exceptional. Typically, oil is more commodity related, and so therefore would be short term oriented. But we have seen real improvement, particularly in the last 2 months, in the oil-related sector. We have seen some negative in the aggressive growth issues where they pulled back. The high momentum stocks have lost momentum. Also, automobile manufacturers have not been doing well, but automobile parts have done well. So there is a group of industries that now have been performing well. There has been some rotation among those, but overall the trend in those areas have been quite positive.
That was Dodge O'Dolan, Chairman and Chief Investment Officer of London Fuse Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.